Welcome back to Money Mechanics. Let us make your money work harder than you do.
Your savings account probably pays you around 0.4% a year. The bank then lends that same money out at 7, 12, sometimes 20%. The gap between those two numbers is not a rounding error. It is the entire business. I am Sterling. Today we are going to open up a retail bank and look at the machinery that actually turns your money into their money. None of this is illegal. Most of it is not even hidden. It is just quietly boring enough that almost nobody reads it. By the end, you will see exactly where the profit comes from and how to stop being the raw material. A bank looks like a building, a vault, a friendly person at a desk who calls you by name. But a bank is really a machine for buying money cheap and selling it dear. It buys your money by paying you a tiny bit of interest to keep your deposit. Then it sells that money to borrowers at a much higher rate. The difference is called the interest rate spread, and it is the oldest trick in the business. Everything else is a variation on it. Let us put numbers on it. Say you deposit $10,000. The bank might pay you $40 a year. It lends your $10,000 out as part of a car loan at 8%. That loan earns the bank $800 a year. It paid you $40. It collected $800. It keeps the difference for doing very little except sitting in the middle. Multiply that across millions of depositors and you start to understand the marble floors. Now, here is the part that sounds like a conspiracy but is written into the rules. Banks do not just lend out the money you deposited. They lend out far more than they hold. This is the lending multiplier. You deposit money, the bank keeps a small slice and lends the rest. That lent money gets spent, deposited at another bank, and lent again. In this way, the banking system as a whole creates far more loans than there is original cash. Every one of those loans charges interest that flows back to a bank. So the same original dollar can support many dollars of lending, each one earning interest. This is not a secret scheme. It is fractional reserve banking, and it is how modern credit works. But it does mean the bank profits from a supply of money that is, in a real sense, conjured out of your deposit. You provided the seed, they kept most of the harvest. The spread is the quiet engine, the fees are the loud one. Overdraft charges are the classic example. Spend a few dollars more than you have and many banks charge a flat fee. That fee is often $30 to $35, whether you overdrew by $5 or $500. Order the transactions the right way, and one small mistake can trigger several fees in a single day. There are also monthly maintenance fees, minimum balance fees, and out-of-network cash machine fees. Each one is small. Together, across millions of accounts, they are enormous. Here is the uncomfortable truth about overdraft fees. The customers who pay them most are usually the ones with the least. People with comfortable balances rarely overdraw. People living close to the edge do it often. So a large share of fee income is collected, in effect, from those who can least afford it. That is not an accident of the system. For a long time, it was a feature of it. Then there is the credit card, which may be the single most profitable product a bank sells you. A credit card makes money in two directions at once. First, interest. Carry a balance, and you often pay 18 to 25% a year on it. That is one of the highest interest rates most people will ever pay on anything. Second, interchange. Every time you swipe, the store pays a small percentage to your bank. You feel like the customer, but in that moment you are also the product being sold to the merchant. Think about how clever that is. If you pay your card in full, the bank still earned the interchange fee from the store. If you carry a balance, the bank earns the interchange fee and the interest. There is almost no version of the transaction where the bank does not get paid. The rewards points you love are, in part, funded by the fees baked into the price of everything you buy. The biggest spread of all is not on your checking account. It is on the money the bank lends for the long haul. Mortgages, auto loans, and business loans tie up money for years at a fixed higher rate. And while your deposit sits there earning almost nothing, the bank earns that spread every single day. There is even a name for the money resting in your account before you spend it: the float. The float is all the cash sitting in accounts, in transit, waiting to move. At any moment, a huge pool of your money is simply parked with the bank. The bank does not let that pool sit idle. It puts it to work, earning interest around the clock. A payment that takes a few days to clear is a few more days the bank holds your money. None of it feels like a fee because you never see a charge. You quietly finance the bank by letting your money rest where they can use it. Here is a twist most people miss. Banks often make more money when interest rates rise, not less. When rates go up, the bank quickly charges borrowers more on loans and cards. But the interest it pays you on deposits tends to crawl upward slowly, if at all. So the spread widens, and the gap between what you earn and what they charge gets even bigger. Watch what happens the next time rates climb. Your credit card rate can jump within a single billing cycle. A new car loan gets more expensive almost immediately, but your savings rate at a big bank may barely move for months. That lag is not an accident. It is the spread quietly working in the bank's favor. Rising rates are often very good news, just usually for the bank and not for you. This is why free banking is a phrase worth questioning. A free checking account can still earn the bank money in several quiet ways. It holds your deposit and lends it out at a spread, as we saw. It collects interchange every time you use the attached debit card. It may charge you a fee the 1 month your balance dips too low. Free in banking usually means you cannot see the price, not that there is no price. None of this makes banks villains. We need credit, safe deposits, and payment systems that work. But it is worth being clear-eyed. A bank is a business, and its business is the gap between what it pays you and what it charges you. When the product is free, the margin is somewhere you are not looking. The good news is that once you can see the machine, you can stop feeding it for free. So here is how you stop being the raw material. Keep your idle cash in a high-yield savings account where the spread is smaller and more of the interest is yours. Turn on overdraft protection or a low balance alert and starve the fee engine. Pay your credit card in full every month so you keep the rewards and hand back the interest. Read the fee schedule once. It is boring, and that is exactly why they count on you skipping it. Move your money to where it works for you instead of quietly working for them. The banks are not doing anything mysterious. They are simply very good at being the calm middle of every transaction, taking a small, steady cut. Your job is not to hate the machine. It is to understand it well enough that the cut it takes from you gets smaller every year. Pay yourself the spread, skip the fees, let the interest run in your direction for once. I am Sterling. If you want more plain-spoken money mechanics like this, subscribe and keep your eyes open. The details are boring on purpose, and that is precisely where the money hides.
And that is how the money really works. If this helped, subscribe to Money Mechanics. Your future self will thank you.